Welcome to the second interview with Danielle Park, the author of Juggling Dynamite, and which I presume is a bestseller by now, Danielle?
I think it's on its way, actually. The market's been quite helpful in that, recent developments.
Yeah, you could basically say, I told you so far, right? So the question going forward is, what do we do now? The book, apart from, in my opinion, a little bit bearish, you're saying you're a realist, but apart from that aspect, what we touched on it last time, is your criticism of the Canadian financial services industry. You said basically it's an equity culture, and all these financial advisors, counseling, buying, and holding are just doing it to pad their own accounts. They don't really care about their clients. Can you elaborate on that?
Yeah, I think that's a bit harsh. There's an excellent article I don't mean that they don't care about their clients, but what's called cognitive dissonance is a terrible state of mind. And it plagues the industry. And I don't mean just the Canadian financial industry, I mean the financial industry in general. Really, if you think about it, the financial industry is the most spectacular pyramid scheme ever invented. And the issue really is, how are you going to use it to your advantage? And how are you going to participate in it? Which means, again, back to what is your discipline? Because there's a whole host of people offering you all these wonderful products. You need to have someone that's actually filtering that and making the choices. Now, whether that's the individual who empowers themselves against the industry and says, that's okay, you can tell me all your buy ideas because I personally know what I want to buy, how much of it I want to buy, when I think it's a good value, and when I don't. Very few humans have that discipline themselves, the individuals. Some do, and I encourage them to get it. If they don't have it, try and develop those rules. And then they can also use someone like that is an actual independent fiduciary who's equipped to make those decisions. So that's the number one thing. About the industry itself, Al Gore said it's hard to get someone to question the basis for a belief system when their paycheck depends upon it. That is exactly what I'm saying about the industry. Most people mean well, but they are doing harm with the advice that they are giving people. And anybody that's worked with a series, I meet people every day. They've worked with a series of brokers and financial planners over the years, and they all have a very similar story. They say, it starts out very strong and full of hope. They seem very nice. They seem very smart. And then I get into the business cycle, and all of a sudden I start to lose money. And then I decide that they're not doing a good job for me and I fire them. So, failure to understand market cycles is the number one reason that most advisors don't actually add any actual value for their fee to clients, and the reason why most clients are sort of just blindly riding this cycle up and down and losing money every 4 or 5 years and not understanding. They think it's the person they're with. They don't realize that the whole industry is generally suffering from the same issue.
Now, the industry will say that there's safety and diversification in asset allocation. Your book has a chapter in asset allocation and expected returns, I believe. But let's say a wrap account like Quotential. Franklin Templeton sold like $8 billion worth of Quotential. They have, each one is a portfolio of 8 mutual funds, which are geared to whether you're conservative, aggressive, etc. You would think that'd be a fair bit of safety, or something like Manulife's Income Plus, where they actually have a downside guarantee. There are a lot of downside guarantee products. Do they work?
Well, they're incredibly rich in their fee structure, number one. Okay, so what I talk about in the book is that equities in themselves are no diversity. Spreading risk around in a basket of equities. We look at what's
spreading your losses around the world, I call it.
Spreading your losses around the world. So again, what is the value of that as a strategy? It's basically back to this idea, well, it's not 2 companies, so if one goes bankrupt, you lose half your money. At least if you're spreading it in a basket, you're not going to lose your money if one goes bankrupt. Okay, I get that. From a company-specific risk perspective, holding a basket of equities makes some sense. But the thing that's very seldom touched on, which is the real virtue of actual risk management, is the fact that equities drop in concert all around the world at the end of a business cycle. So spreading them around is not going to help protect you from a bear market decline. And I was just flipping through your book, Crash, and in there even you acknowledge that, a bear market can take away months and years of gains in a matter of days. So a bear market is your greatest risk. Now, how do you protect yourself against bear markets? Again, back to this idea that you can't just buy and hold. You can't just spread stuff around in equities and think that's good enough. You have to have an actual discipline to control your exposure to the business cycle, to the equity cycle.
Now, some advisors would say, if you're still accumulating wealth, why wouldn't you want a bear market? Why wouldn't you want stocks to go down? You're buying in monthly. The more it goes down, the better value you're getting. And eventually, 20 years from now, if the bull market comes back, then you're laughing.
Yeah, but that's not the reality of the way people accumulate money. I think you know this from your own experience, no doubt. Most people don't have any money in their 20s and their 30s. You know, they're lucky to get some mortgage paid down on their house. And okay, if they're starting at 20 and they have $100 a month to save, maybe you do just take a nice conservative, balanced mutual fund and put $100 a month into it and sort of accumulate money over time. But the real way that people come to money in life is not like that, mostly. Mostly they come to it in lump sums, and it comes later in life, when they can least afford to suffer a big decline. You know, and psychologically and emotionally, these things have very serious impacts. It isn't, a small thing to have 20% of your life savings drop off your statement. Even if it comes back in the next cycle, like over a 4 or 5 year period, even if it recovers, as it did from 2000, people lost 45% of their money in the 2000 bear market and then gained it back from 02 to 07, slowly, but got back to par if they stayed with it and all that. But then, you've spent 7 and 8 years of frustration and anxiety and feeling that you got nowhere. You've probably fired 1 or 2 advisors already in that cycle because you've decided that they're not doing a good job for you. So the way that humans respond to a bear market is just really bad. And it's not something you can just say, oh, well.
Now, if somebody will say that if you're spread across the 5 major sectors and you have quality, large cap, dividend paying stocks, why not just be happy, collect your 3 or 4% dividend and ride it out?
Well, again, back to the whole point of holding equities. The whole point of holding equities is to get some risk-adjusted return above the rate of inflation, right? That is the point. Okay. If we look at long-term gains on equities, the primary bulk of that 7% that Jeremy Siegel likes to talk about came in the form of dividends over that 200-year time frame, that he cites in his work from the 1800s. 7% returns over that period of time. Almost 5% of that came from dividend yield. So we're in a time when dividend yields are ridiculously low. They've come up a little bit with the correction that's happened recently, but essentially equity products have been priced as if they were fixed income for the last couple of years, few years actually. So you had things like real estate investment trusts, equity-based REITs that were paying, less than government Canada bonds. So what I'm saying is price matters. You can't just, say I'm going to buy high-yielding stocks and forget about it. What if there are no high-yielding stocks?
The S&P 500, I read the other day, the PE ratio is something like 14. It's a little below what it's been. We're certainly not like 1999, 2000, where stocks were ridiculously overvalued on the NASDAQ.
Well, it depends. How do you get a PE? You get price and you get earnings. What's the problem with that? Earnings, the expectations for earnings have been ridiculously high and continue to be too high and too optimistic. As we were expecting 8% in the last quarter. The analysts were saying we're not going to get double-digit earnings growth, but we're going to get at least 8%. What did we get? Minus 26. So once you start taking away the E from that PE equation, your pricing is all based on expectation of what might happen down the road. So I would suggest to you that when you get, a contraction in earnings like we're in right now, we're in a very serious contraction. I don't care if you call it a recession or, a depression, whatever. I don't call it those things in particular. I just say very serious earnings compression, not through it yet. Just started into the resets on subprime, impacting all the major sectors. You would be really naive to think that earnings don't have to compress further from here, in which case you can't confidently say, well, the PE is obviously attractive at 14 because relatively it was 18, so 14. Yes, it's cheaper by that metric. But until we know what earnings really are shaping up to be and how long this contraction is going to go on, you really can't make those sort of easy, oh, well, I'm going to buy because the valuations look great.
Okay, so addressing people who are watching this midwinter 2008, and the market's already 20% down below it was. They didn't read the book. They didn't do anything.
Not the Canadian market, right? But yes.
The U.S. market.
Yes.
And the Canadian market is down substantially as well. What do they do now? Are you advocating staying cash, strip bond ladders, or would you even like to use reverse index funds, which I think we've discussed in the past?
Mm-hmm. Well, that's a very good question. It's one that I get every single day now, because people have, some of them read my book a year ago and they call and say, I didn't do anything then, and now I've lost 20% of my money. What do I do now? So the first thing I would say is take this opportunity to, do some real reading and understanding of what's going on around you, so that you don't keep making these same mistakes. You should have had a sell rule before now. Okay, you didn't. Okay, you're still fully invested. It's not ideal that you've lost 20% at this point. And I can't promise them that they're going to lose more if they stay in the market. But I would suggest to you that we still don't have a buy on most major sectors in our work. That's the tool that has kept us out of trouble. That's the tool that has let us make money when other people have been losing a lot over the last 14 and 15 months. So we don't have a buy signal. So if a client comes to me right now and says, here's my portfolio, I've got a bunch of banks, a bunch of this, a bunch of that, the chances are that that we'll look at that and decide to downsize their equities now, even though I wished we'd had them a year ago to do it. Because I think, again, back to where we are in this cycle, we still haven't had any really significant downside in equity markets relative to what's been going on in the economy.
Now, addressing our wealthy boomer audience here of, let's say, 10 years from retirement, what would your asset allocation for one of them be? I mean, compared to the average balance fund, would you be out of equities altogether, or would you just take it down to half normal exposure?
No, we're not passive. We're very tactical in what we do. So that means if you come to me and you're 50 years old, chances are we will have an asset allocation that is part bonds, part equities. It's the equity weight that may be 80% left in T-bills at this point.
Okay, well, thank you, Danielle. People can get more information on Juggling Dynamite at your website, jugglingdynamite.com, and which also has a blog which is updated most days of the week with your varying perceptions of this interesting times we live in. Thanks for being my guest.
Thank you, Jonathan.